start things off, I'm going to go through some of the essential things that you need to know when you're thinking about considering investment trusts for your portfolio. I do mention a couple of names of specific investment trusts. Again, we don't offer advice at all. It's really important that if you're unsure, please consult a suitably qualified financial advisor. So I thought it'd be quite a good way to start things off by just explaining how investment trusts sort of slot into the bigger picture. I think lots of people, when they're thinking about investments, think, okay, is there something that I can potentially put into my ISA or my pension or just my general investment account where it will give me broad diversified exposure through a single product? And in a nutshell, that's what a fund would do. That's its role. One product, very big diversification. And to me, I always think they're a bit like when you go out and buy an assorted box of biscuits. You're just buying that one box, but within there's lots of different flavors. And so investment trust, whilst technically investment trust as a company, I think it's probably easier to think of it as similar to a fund, or exchange traded fund, or ETF is another term. All these different types of funds really have exposure to a portfolio that contains lots of different things. So whether that's lots of shares, or it might be lots of different bonds, or sort of a mixture of them, they all kind of do the same things. But I've got a little graphic which will hopefully explain some of these key differences. So let's start off with funds, the traditional sort of funds. So here, this is the idea that you put in an order for a fund. It's called open-ended fund because the fund manager, when they receive an order for a fund, they create a new unit or a new share of the fund. When you want to sell, they redeem that back off you and cancel it. So the number of sort of funds, units, or shares fluctuates in line with how many people are invested at a time. These funds are only priced once a day. So for example, if you put £1,000 into a specific fund, it might be that you don't actually find out the price that you pay until that trade settles. It could be a couple of days to get that information. Whilst you might think that's a downside, a lot of people are attracted to funds because they will always trade in line with the value of the underlying portfolio. Other types of sort of fund products like ETFs, investment trusts, don't always do this. So there's two different types of funds. One is called an active fund, which is where a fund manager or a team of managers, they make all the decisions about what goes in and out of that portfolio. Now, you pay a small charge for this each year for their services, and it's built into the product. A passive fund is where you haven't got a fund manager making decisions, but really it's just the fund is tracking an index. So an easy way to think about what is an index, it's a basket of things like shares or bonds, and the membership of a specific index is essentially dictated by a computer following a set of rules. So for example, if you take the FTSE 100 tracker fund, that is designed to mirror the performance of the FTSE 100, which itself is a basket of the 100 biggest companies on the UK stock market. So if your FTSE 100 tracker fund, it should mirror exactly that performance. So FTSE 100 up, let's say 5% in a month, your tracker fund should do the same, minus the small bit of charges that are built into this product. Now, that's quite similar to an exchange traded fund or an ETF. They are mostly, not all, but mostly passive funds as well. They are tracking index, they're low cost, but they differ because ETFs actually trade on the stock market, and that means their price can continuously move throughout the trading day. And that's influenced by how many people are placing orders to buy or sell those ETFs. But really, it's a really straightforward way of following a specific part of the market. Now, investment trusts are probably, you know, their closest, you know, thing that you can compare it against is an active open-ended fund, because in both cases they are providing exposure to a portfolio of assets, and the decisions about what goes in and out are being decided by an active manager. But where they differ is that investment trusts are close-ended, which means that they have a set amount of shares in issue, and we'll hear a little bit more later on about what that really means. The price does change throughout the day based on market demand, and actually you can sometimes buy a investment trust for much less than the underlying value of its portfolio, or sometimes a little bit more, and that's called premiums and discounts. So I will also come to that in a second. But really, if you were to say, well, what really makes investment trusts truly different from traditional funds or ETFs, it's because investment trusts can actually hold back some of their income in reserve, and essentially it tops up dividends through sort of more difficult periods. They can also borrow money, and again, Emma will talk about the ins and outs of how that works in her presentation. So the investment trust world has got lots to choose from. I think if you were looking for exposure to the broad global stock market, there's quite a few sort of global equity themed products. You hear the term equity, that's another term for stocks and shares. You can actually get investment trusts that just focus on a certain part of the world. It might be companies that are on the stock market in Japan, for example, or even in the UK. You can get ones that focus just on a specific industry. Some examples are renewable energy or healthcare, technology. You can get ones that invest in different asset classes like shares or bonds or property. Some of them have got different styles. It might be badged as, you know, an income themed investment trust. And for example, someone in retirement might look to their investments to generate a regular income. So obviously when they were working, they were, you know, every month in their bank account, they'd see their salary paid in. When they retire, they turn to investments to potentially replace that income that they once had from their salary. So they've got regular money coming in to help pay the bills. Now, someone who is still working doesn't need to get an income from their investments, might want to look at a growth style investment trust. This could be the sort of thing that would potentially interest them. But equally, someone might want income and a bit of growth as well. I certainly think if you're in your early stages of retirement, you think, okay, I want my income to help pay the bills, but actually I want to think about making sure that my portfolio keeps growing in value so I don't run out of money to the time I'm in retirement. So it all depends on individual personal circumstances, which one you perhaps might want to go. And some people have a little bit mixture of all of them. But you can also choose from different sized companies within the portfolio. So I guess, you know, if there's hundreds of products available, how on earth do you start to think about which ones you might want to research in a bit more detail? Well, one way is to go onto AJ Bell's website and go onto the homepage, and you can click the Funds tab and then click something called Investment Trust Screener. And what this is a neat little search system to help narrow it down. So it will look like this when you go onto your website, or there is. It's fairly straightforward. You can search by a certain sector or by a certain asset management provider. And if you click the advanced filters, you can search for even more criteria. And actually, this works for funds, ETFs, investment trusts, and shares. So hopefully that would help you narrow it down to based on what particularly you're after. But there's another way as well, which is, you know, in AJ Bell, we actually have a team who spend a lot of time researching the investment trust universe. Now they're looking for specific qualities in investment trusts because they're trying to find who really stands out from the crowd based on certain criteria. So what you want to do is go on to the homepage again, click the Funds tab, and then click our Investment Trust Select List. And so our experts are looking for various things like investment philosophy. Now, why does the manager believe that they have what it takes to outperform the market? Because this is an important thing to remember. People are attracted to investment trusts because they're actively managed, and really the goal here is to beat the market as much as they can on a regular basis. Now, as part of our research process, we'll look at process. How do these managers go about building their portfolio, and what do they do think about risk management? What sort of expertise have they got in the team? Are these sort of trusts offering any value for money? What's the performance like? Now, we would never single out a trust and put it on our investment trust select list simply based on performance. It would be a combination of lots of different metrics. But I think it's really important to look back and think, has investment trust performed as you would expect in certain situations against what it's trying to achieve? And then finally, we would look for size. And we look for trusts that are £200 million or bigger. But obviously, some people will look at the whole market. It's just what we're up to. Finally on that, just on this area, really important to emphasize, we're not making investment recommendations here. We're simply trying to highlight ones that stand out for us because of certain characteristics. Now, you might hear the term NAV quite a lot when you're reading up about investment trusts. Now, this stands for net asset value, and it's the underlying value of a portfolio. Now, it's really important because fund managers like to be judged based on NAV performance rather than share price performance, because share price can actually be sort of influenced by lots of factors outside of trust's control, what's going on in the market with politics and economics and stuff. So, but if you look at the NAV, it will give you a proper idea about whether a trust is creating value. And when I mentioned earlier about the potential, to buy a trust for slightly less than the underlying value of its assets, that's really important because it's based off an NAV calculation compared to the share price. Now, there's several reasons why trusts will trade on a discount. Mostly, discounts are more common than premiums, but for a discount, it exists either because that investment trust is invested in a part of the market where perhaps investors are worried about something at the moment. It could be changes to regulation, or there's been lots of bad news coming from companies in that area. But it's also to do with liquidity, i.e., how easy is it for the trust to sell its assets should it suddenly decide to do? Trusts don't simply click a finger and say, we're going to liquidate everything, but the market looks at it and just saying, like, how much flexibility or how easy could it be if that situation arose? So something like private equity holdings, where they're not traded on the stock market, it's difficult to suddenly find someone to buy it on the same day, or smaller companies, those types of trusts invested in this areas would naturally have a bigger discount than perhaps larger companies. I put a couple of examples on the screen. One is Mercantile Investment Trust, which is roughly mid-cap, medium-sized companies. That's got a 9% discount at the time I was putting this presentation together. Lance Witten is a bit more, it's very much focused on large companies, and that's got a much smaller discount. Because it's the market is saying we think you've got much more liquid holdings. Now, investment trusts don't particularly want to see their trust trade at a discount or even indeed a premium. So there's things that they do. One is called a discount control mechanism to try and narrow that discount to net asset value. And they would buy back shares, or they would essentially try and raise the profile of the trust, try and encourage more people to buy. It's worth pointing out, so I realized I didn't explain to you how you go about calculating the discount. So let's take a made up trust and say it's got an NAV, net asset value of £1 per share. Its share price is 90 pence. So you can see there's a 10 pence difference there. So what you want to do is try to say, you take the difference between the two and work out as a percentage of the NAV. So in this case, it would be a 10% discount to NAV. Investment trusts can actually trade on premiums when the area in which they're invested is either in hot demand, or investors are sort of wanting to access something they couldn't do otherwise, and so they'd be prepared to pay a little bit more. But it's really quite rare to see trusts, certainly in the current market, trading at premium. And just finally, it's worth pointing out that recently we've had the rise of activist investors. These are external investors coming and basically pouncing on trusts that have been trading at a big discount to net asset value. What they're trying to do is, trying to push the board to do something a little bit different. Either, for example, it could be merging with a rival trust, or may potentially tweaking the investment process to try and narrow that discount, and with the goal of they want to make some money by seeing that discount narrow and then selling out. Some investors have not welcomed this sort of short-term potentially disruption, and so we've seen a lot talked about in this part of the market. But whilst there was an American party that was trying to shake up quite a few trusts, while they didn't succeed in their initial attempts to try and make changes to these trusts, has shone the spotlight on discounts quite a lot, and we've seen a slight narrowing on a general basis across the board. So that's the first, your first sort of steps in trying to understand the basics of investment trusts. I'm now going to hand over to